Let's start with something uncomfortable. Most traders don't lose because the market is unfair. They lose because they don't have a system. Or worse, they think they have one, but they don't follow it. A real trading system isn't just indicators on a chart. It's structure. It's discipline. It's repeatable behavior, and the traders who consistently outperform most retail participants don't rely on luck. They operate under rules, 5 of them, simple, clear, non-negotiable. Rule number 1, define your edge clearly, or don't trade. Most traders take trades based on vague ideas. It looks strong. It might break out. It feels ready. That's not an edge. That's guessing. A real edge is specific. It answers 3 questions. What must happen before I enter? Where exactly do I exit if I'm wrong? Where do I take profit if I'm right? If you cannot explain your setup in 1 or 2 sentences, you don't have a defined edge. You have a preference, and preferences change with emotion. Edges do not. Beating most traders isn't about finding secret indicators. It's about having one repeatable pattern you understand deeply. You don't need 10 setups. You need 1 or 2 that you've studied, back-tested, reviewed, journaled. When you define your edge clearly, you eliminate randomness. And randomness is the enemy of consistency. Most retail traders jump between strategies every month. They abandon setups after a small losing streak. They chase whatever worked last week. But consistency comes from depth, not variety. If you master one clean setup and execute it identically every time, you already outperform most traders who constantly switch systems. Rule number 2, standardize risk on every trade. This is where most traders quietly fail. They think risk management is important, but they don't apply it consistently. One trade is 1%. Another is just this once. That inconsistency destroys stability. The 5, rule trading system doesn't allow emotional sizing. Risk is fixed. If your rule says 1%, not based on confidence, not based on excitement, not based on revenge. Fixed risk creates predictable drawdowns. Predictable drawdowns create emotional control. Let's say you take 10 trades risking 1% each. Worst case, you're down 10%. You can handle that mentally. But if you randomly risk 4% on 2 trades and lose both, you're down 8% instantly. Now emotions take over. And once emotions take over, rules collapse. Most traders don't blow accounts because of strategy failure. They blow accounts because of inconsistent sizing. Small, consistent risk beats aggressive, unpredictable risk. Every time. If you want to beat most traders, you must remove emotional position sizing completely. Your risk should feel boring, almost automatic, because boring behavior produces stable results. Let's talk about why this matters psychologically. When risk is standardized, your brain relaxes. You know the maximum damage per trade. You're not afraid of your own decisions. Fear disappears when exposure is controlled. And when fear disappears, execution improves. Execution quality is what separates disciplined traders from impulsive ones. Now think about this. Most traders obsess over entry precision, but they ignore risk precision. Entry is important, but position size determines survival. And survival is what allows long-term profitability. You cannot beat most traders if you can't survive long enough. Consistency beats intensity. Every single time. When you combine rule number 1 and rule number 2, something powerful happens. You have a defined setup, a fixed risk model. Now you're no longer reacting randomly. You're operating under structure. And structure reduces emotional interference. But we're not done. Because even with a defined edge and standardized risk, most traders still fail. Why? Because they sabotage themselves in subtle ways. And that's where rule number 3 becomes critical. We'll break that down next. And this is where the system truly separates you from the majority. Now we move into the part that quietly destroys most traders, even the ones who have a defined edge and standardized risk. Because having rules is one thing, following them under pressure is another. That's where rule number 3 and rule number 4 come in. And this is where the separation really happens. Rule number 3, only trade A setups, nothing else. Most traders don't lose because their strategy is bad. They lose because they lower their standards. They take B setups. They take almost setups. They take trades because they're bored. They take trades because they missed the last move. That's how consistency disappears. An A setup is not just any setup that fits part of your criteria. It fits all of it. The structure is clear. The risk is defined. The reward is logical. The context supports it. If even one condition is weak, it's not an A setup. And if it's not an A setup, you don't take it. This sounds simple. It's not. Because markets move all day. There's constant temptation. Candles are forming. Breakouts are happening. Volume is increasing. Your brain wants action. But the traders who beat most traders are selective. They understand something most retail traders ignore. You don't get paid for activity. You get paid for precision. Taking fewer trades with higher quality dramatically improves long-term performance. Let's break down why. If your A setups have a positive statistical edge, but your B setups are random, then every B setup trade reduces your overall edge. You dilute your advantage, and over time, diluted edge equals inconsistent results. Most traders would rather be active than disciplined. They confuse movement with PR, progress. But real progress in trading is often invisible. It looks like waiting. It looks like patience. It looks boring. But boring behavior produces stable growth. And stable growth beats emotional spikes every time. Now here's something deeper. When you only trade A setups, your confidence becomes grounded in quality, not luck. You stop wondering whether a loss was avoidable. You know you followed your highest standard. That psychological clarity reduces regret, and reduced regret improves long-term stability. Now let's move into rule number 4. This is the one almost nobody talks about directly. Rule number 4. Predefine when you stop trading. Most traders know when they want to start. Few know when they should stop. And this is where discipline either survives or collapses. There are 3 types of stopping rules you must have. A daily loss limit, a daily trade limit, a mental fatigue limit. Let's start with the daily loss limit. If you lose 3% in a day, you stop. No negotiation, no doubling size to recover. Why? Because once you hit that loss threshold, your psychology shifts. You're no longer trading your edge. You're trading to fix something. And trading to fix something is emotional trading. Emotional trading destroys systems. Next, the daily trade limit. If your system statistically performs best with 2 to 4 trades per session, why are you taking 8? Overtrading usually begins after either a strong win or a frustrating loss. After a win, overconfidence pushes you. After a loss, revenge pushes you. A trade limit prevents both. It creates boundaries. Boundaries protect capital. Boundaries protect discipline. Now the third one, the mental fatigue limit. This one is rarely respected. If you feel distracted, if you feel frustrated, if you feel impatient, you stop. Professional traders understand cognitive fatigue. Your decision-making quality declines after extended stress. Fatigue increases impulsivity. Impulsivity increases inconsistency. Stopping early can save weeks of damage. Most traders don't blow up accounts in one trade. They blow up accounts in one emotional session. Stopping rules eliminate emotional spirals. They act like circuit breakers. Now think about this system so far. Rule number 1, define your edge clearly. Rule number 2, standardize your risk. Rule number 3, only trade A setups. Rule number 4, predefine when you stop trading. Already you're operating differently than most retail traders. You're structured, you're selective, you're protected. But there's one final rule, and it might be the most important one of all, because without it, the first 4 eventually weaken. Rule number 5 is what keeps the entire system alive long term, and it has nothing to do with charts. We'll break that down next. Now we arrive at the final rule, and without this one, the first 4 eventually collapse, because discipline doesn't maintain itself. Structure weak, NS over time if it's not reinforced. Rule number 5, review and refine relentlessly. Most traders review charts. Very few review behavior. That's the difference. Beating most traders is not about having a perfect strategy. It's about improving execution continuously. At the end of every trading day, you should ask yourself 3 questions. Did I take only A setups? Did I respect my risk and stopping limits? If the answer is yes, it was a successful day, regardless of profit. If the answer is no, profit doesn't matter, because broken discipline eventually gets punished. Reviewing is what turns mistakes into data, and data builds improvement. Let's go deeper. Most traders think journaling is optional. It's not. Your trading journal is your accountability partner. It exposes patterns you can't see in the moment. Maybe you overtrade after a win. Maybe you hesitate after 2 losses. Maybe you size up when you feel confident. Without reviewing behavior, those patterns repeat silently, and repetition of bad behavior destroys consistency. Professional traders refine constantly. They tweak entry precision. They analyze win rate distribution. They track average reward to risk ratios. They monitor drawdown levels. But more importantly, they monitor themselves. Self-awareness is a competitive advantage. Now let's zoom out. When you combine all 5 rules, something powerful happens. You're no longer reacting emotionally to markets. You're operating under a framework. Let's recap the system clearly. Rule number 1. Define your edge clearly. You trade only what you understand deeply. Rule number 2. Standardize your risk. You remove emotional sizing completely. Rule number 3. Only trade A setups. You protect your statistical advantage. Rule number 4. Predefine when you stop trading. You prevent emotional spirals. Rule number 5. Review and refine relentlessly. You turn experience into improvement. This is not flashy. This is not exciting. It's structured. And structure beats emotion every time. Now let's address something important. This system does not guarantee you will win every week. It guarantees something more important. Stability. Most traders chase explosive growth. But explosive growth usually comes with explosive drawdowns. Stable growth compounds. When you follow these 5 rules consistently, your equity curve smooths out. Losses feel manageable. Wins feel controlled. Drawdowns feel contained. And over time, that stability creates confidence, not emotional confidence. Process confidence doesn't disappear after a red day. It doesn't inflate after a green streak. It remains steady, and steady traders survive. Survival is underrated. You cannot outperform most traders if you don't last longer than them. Most traders quit. Most traders over-leverage. Most traders chase. Most traders abandon systems during drawdowns. If you simply remain disciplined while others react emotionally, you already have an edge. Now imagine applying these 5 rules for 1 year. Not 1 week, not 1 month. 1 year, defined edge, fixed risk, selective entries, strict stopping rules, relentless review. That consistency compounds. Not just financially, your decision-making becomes calmer. Your reactions become slower and more intentional. Your equity curve becomes more predictable. And predictability is powerful, because predictability reduces stress. Reduced stress improves clarity. Clear decisions produce better outcomes, and better outcomes reinforce discipline. It becomes a positive feedback loop, but only if you commit fully. Partial commitment creates partial results. You can't follow rule number 2 sometimes. You can't apply rule number 4 only when it's convenient. This system works because it removes emotional variability. And emotional variability is what destroys most retail accounts. Let's be honest. There is no magic indicator. There is no secret strategy that beats everything. But there is disciplined structure. And disciplined structure beats most traders because most traders lack it. They chase, you define. They overtrade, you select. They panic. You stop. They blame the market. You review yourself. That difference compounds. And compounding discipline over time is what creates long-term profitability. This is not about hype. It's about operating like a professional. If you want to outperform most traders, stop trying to outsmart the market. Start out-disciplining it, because markets reward structure and punish emotion. The 5-rule trading system isn't complicated. It's controlled, and control is rare. If you can master control, you don't need to beat everything. You just need to beat the majority. And with these 5 rules applied consistently, you will.